What is up, UMortgage faithful? Welcome to the Monday market update where we talk about mortgages, where we talk about bonds, where we talk about the winds of change throughout our economy. I am Sean Grapevine, director of Agent Direct, coming to you live from our studio here in Atlanta, Georgia. I am joined this week, as with every week, by a certain man who needs no introduction, but will receive one anyway. He's the Mac of the rate stack. I think he ate his bips for breakfast. He does best efforts. Look at him with no effort. His GPA at the University of Texas was higher than today's 10-year T-note. That joke doesn't land anymore. It's literally impossible. He's the Baron of Bips. He's the Lord of the Locks. He is not unlike Jerome Powell with his finger over the power button of the money printer, not unlike the way Ranger Suarez of the Philadelphia Phillies held the bats at bay of the Atlanta Braves, an historic offense that I'm sure we'll research tonight. In the same way, Austin Koenig is holding his finger over the lock trigger, awaiting you to send in your lock request right this moment. That's okay. Hey, if you got a lock request and you're watching this, you can go ahead and shut this down, watch it later. Go ahead and get it on in, because Austin Koenig, you can't see his hands there, but they are hovering over the trigger. He's the king of collateralized debt. He's the colossus of credit. He's the man who's more liquid than the Chinese real estate market. He's awesome. He is Austin. He is Austin Koenig. Welcome, Austin.
Thank you, Sean. The great intro as always. And obviously, we're doing this on a day where the market is not even open. So equities are open. Actually, I shouldn't say everything, but all fixed income that we deal with and we talk about for mortgages, that is all closed today. So
talk about faithful. You and I mean, just in it to win it.
No question. It's a dedication to the lift of the game. But appreciate you hopping on again, and it's always great to talk. I think, do you want to kind of recap what happened last week, and then we can kind of go forward from there? We don't have anything today, obviously, that's going to happen.
Sure. So like I said, Ranger Suarez came in and held the Braves bats pretty silent for I think about 5 1/3 innings, and then a coalition of bullpen arms continued to keep the Atlanta Braves historic bats at bay. So, you're talking about for the market?
Yeah, we could talk about the market. I don't want to talk about sports this weekend for my own personal reasons too.
Okay, so everybody hurts, huh? Everybody hurts.
Yeah, everyone hurts. But if you're
tell us about last week.
So we had ADP jobs come out on Wednesday, which was actually we've had this a lot in this past year, where ADP and the non-farm payrolls are kind of two completely different readings, where we saw ADP come in way below expectations. Looked like a softer labor market, softer demand, softer hiring trend that we're seeing, and then all of a sudden non-farm payrolls really kind of blew the expectation out of the water. We had about a 336 print or something along those lines. I might not get that number exactly right, but we were expecting somewhere.
It was a lot. It was a big number. It was a big
correct. It was a big number. Unemployment really came in not changed at all, which was not exactly expected. Unemployment was expected to tick down slightly. It stayed at 3.8. I mean, those are kind of just rounding numbers at that point. We're fighting over, like we always like to talk about bips. That's literally basis points of unemployment we're kind of looking at here. So nothing too extreme, but the market kind of reacted harshly to it. But the day kind of improved. Stocks did better. Bonds eventually did a little bit better. But we have a conflict in the Middle East with Israel and Hamas, and that's going to be a very first of all, it's terrible to see what's going on. We never want to see violence, especially like civilians being hurt, obviously. But this is another conflict that we have to really pay attention to, and how that affects the worldwide market as well. One reaction immediately, is oil that happens, and that's going to go up in price. But at the same time, we'll have to see how other policies and other, things happen as we develop. We kind of think about what happened in Ukraine and Russia, well over a year ago, in that conflict, and how that impacted markets as well. and that was, I think, at the end of 2020, beginning of 2022, correct? I think that's when that kind of came through, and that those were times where the market was pushed in another direction than maybe it should have. So we'll see what kind of happens from that, and we're going to have a very interesting week with CPI coming out later this week as well. So this is going to be a very busy week once the market hits the ground running tomorrow, I feel like.
Yeah, really, pretty rough news there on the job market front. I mean, I'm happy for those 336,000 people. Don't get me wrong, thrilled, just absolutely chuffed. But yeah, I mean, a number way bigger than expected, and yeah, like you said, unemployment is kind of like it's sort of like a secondary or tertiary measure of like a couple other things that like I think most people's eyes seem to be on that headline number. It's like we can't really control how many people leave the workforce, stay in the workforce, that kind of thing. But yeah, 336,000. That number is pretty big, and comes on the heels of what we thought, or maybe continue to think, was a cooling uh, inflation environment. We got PCE the prior week; it was down. The 3 month average was at 2.2%. I mean, it's exactly where we would want it to be, and we think, right, like, or economists think, the Fed thinks anyway, that inflation is tied to wages, and wages are tied to job growth. That being said, we are seeing jobs continue to be, produced or hired for, and we think that we are continuing to see inflation, continue to cool. So, is there some point where the Fed admits that there's a disconnect between, like, uh, wa- job growth and inflation? Like, are we no is the dreaded wage spiral, right? Wage inflation spiral. Like, is that have we maybe avoided that? Have we tamped it down, or are we just getting some noise as things kind of revert to the
That
mean?
that's a great question, Sean. I think what we're trying to do is, you know, thin a very small line here. We're really kind of like trying to border, hey, we don't want to kill, the ability to have jobs or like really shoot unemployment rate way above where we want it to where we have to have this actually stimulate the economy. But we don't want to, kind of what happened in 2021. The labor market was a labor market, that was really, and it was kind of like, we talk about buyer markets and seller markets in the housing market. It was definitely the employee market in
Right.
2021, where, if you're looking around, you say, hey, like, I have all these different like job opportunities. I can go leave my current role and go grab another job, maybe get a 10%, 20%, even more raise, for example. And you saw that come into the numbers as well. With that being said, nowadays I think that reality is not necessarily where there's tons of people that are moving jobs based off of huge pay raises they're able to get on, the open job market. I think they're a lot more marginal, if anything. And if with that being said too, that's kind of what the Fed wants, is not some really hot labor market where good labor's in too high of demand. I think there's still a lot of skilled labor demand, but it's not tons of dollars just chasing like a very small supply. It's that demand has gone down, and that supply is actually kind of starting to pick up from an extent of, like, you're seeing the labor force participation rate get better from where it used to be. You saw that when the unemployment rate went up, there's actually more people coming back to the labor force. That's a good thing. We wanted to see people come back to the labor force to kind of re-establish the supply and demand dynamics. And I think all things considered, the way the Fed has to look at this is like, all right, great. We're seeing this normalize. Wage growth is not running rampant hot, but what if we just kind of decide to flip too early? Could that kind of pick up again? That's what they're scared of at the end of the day. So I think that's the main catch-22 that they're dealing with when they are looking at wages. But at the end of the day, what the market has to look at is, okay, we have two more meetings this year. I think the market really is pricing at least 50%, if not more, that we're going to see one more hike. So basically saying over the next two, we'll probably have one more hike. But that could all change with how data and other things that are outside of the data that we get provided. how they can possibly change that sort of positioning. But for right now, that's what the market is thinking, and trying to grapple with the higher for longer and how much they buy into that higher for longer talk that the Fed's been reiterating, especially recently.
Oh yeah, yeah. Well, hey, I mean, they should have listened to me. I've been saying it since 6 months ago. The Fed's not
Yep.
going to waste the arrows in their quiver quickly, even if things do get bad. But I'm not sure. I expected them to continue to fashion arrows and put more into their quiver and buy a bigger quiver and stuff it full of rate hike arrows. So I'm impressed at their ability as Fletchers to do that, to continue the metaphor there. Fletcher is a person who makes arrows, for those of you keeping track at home. All right, so we've got CPI. This is, I think like more than ever, some of these readings feel sort of make or break. What does the market think CPI is going to look like, core and regular? Like, what's the bet?
So I have the expectations right in front of me. What we
Nice.
have,
You knew I was going to ask.
exactly. So we're expecting to see headline CPI print, the year-over-year metric that we kind of always quote on the news headlines of 3.6. We had 3.7 last time. Month over month for core and regular CPI is a 0.3% increase. And so I know we talked about PCE, having that really small, 3-month metric, where if you analyze it, it's only 2.2%. We're seeing 0.3% for both month over month metrics for core and CPI. I think seeing, if we're looking at core CPI, not just the regular CPI that I quoted earlier, last month it was 4.3. We're expecting to get 4.1. So we're hoping to see some good progress there. We would love to see core come down quick. Better print on core will be fantastic. It's going to be tough to get, I think, a great CPI print that's, accounting for energy, because we've seen oil prices really kind of get expensive, especially most of September. So I wouldn't expect a miracle there, but maybe core looks pretty good. So we'll kind of see how this prints out, and that's going to be on the 12th, which is Thursday. We have PPI the day before, but it's pretty quiet until Wednesday in terms of a data standpoint. So big way to kind of end the week, though.
All right. Well, we'll be on the lookout for it. I assume you and the rest of the capital markets team and Mr. Rob Piccolo are, still on the "if you like it, lock it" train.
Yeah, I think no one's hopping off that train anytime soon. So
Hey,
yeah, we're still on that
what
train.
if you don't like it? Should you still lock it?
As long as the borrower likes it, and they're comfortable with it, I think that's the path you have to take. You can't be a betting man in this market. It's the house is going to win.
you will be punished. Yeah,
Yeah.
I mean, there hasn't been a single week in the last 6 months where that won't have just punished you, or really the borrower or the organization. So definitely, if you like it, lock it. If you got any time machines, go back in time and lock it. Don't wait, for sure. Any new exciting news on the product, process, or partner front?
Yeah, so we're continually evaluating more and more, different DPA programs as well as other lenders. I would actually, just for today's call out, I would have everyone go back and watch Friday's sale huddle if they missed it. We had a new lender that we're slowly rolling out this month, Advantial. They're based out of Dallas, but they have a lot of different bespoke products that we can add to our portfolio. And I'm not gonna do a 5-minute deep dive onto them right here, but I'd recommend all of you guys check them out, and reach out to the RE if you want more information on any sort of products, or feel free to ask Rob and I if you have any questions on the back of that sales huddle. So all things considered, that's kind of my main call to action, and we'll have more of those. I don't actually know who's on to, this Friday's sale huddle, but we'll obviously post you guys as that comes along. So appreciate you guys hopping on as always, though, and it's been great talking to you as every Monday, Sean.
Wow, great talking to you as well. Way to lead us towards a close. Appreciate all of you out there in TV land watching. Please feel free to get at myself or Austin if you have any questions about how secondary markets work. If you want us to cover any particular topics on these calls, we are here to serve you. That being said, let's all go get some loans. I hope you guys have a great week. Thanks,
Thank you,
all.
everyone.